So I think the real shocker here will be silver, not so much gold. Yes, gold has gone into price acceleration while silver's built this pattern on momentum that says I haven't even begun.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 29th through May 6, 2025, while supplies last. First this week, we featured 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine, and we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. And finally, backdated 1/10-ounce Platinum UK Britannia are just $29 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
You're back, Elijah.
Well, it's great to have you today. I did want to discuss, what is happening in the precious metal markets first and foremost, as we saw gold since the last time we talked rally up to an all-time high of nearly $3,500. Now we're pulling back about $300 or so as we record this on Friday, May 2nd. Your perspective on where gold sits right now?
I think it's in a briefer corrective process than we've seen prior to this. Over the last year, for example, if you'll look at what gold did, it moved up in layers and sometimes would be stuck in a horizontal zone for a handful of months. Go back to April of 24, for example. We said in March of 24, expect the beginning of the bull market again. In other words, it's been asleep for 3 years. And it's sure enough, it engaged, but it still had these layered, time-consuming zones of nothing. Where we just simply hold and absorb the selling and finally can go up again. Well, right now we're in the second week of a pullback period. So in fact, it's not even a full 2 weeks because, anyway, the number of days is a handful. And I suspect this will be brief. It won't be multi-month. I don't think we're going to correct like everybody seems to think. We're going down to 2,800. I think what people are doing, our price chart is primarily, is when they project, it's all over for now, we got to go back down to here. Every time they do that, what they're doing is they're finding the prior shelf of highs that was broken through, and then you get a surge, and they seem to insist that you must go back to that prior high to test the price high. And gold hasn't done that. Instead, it's pulled back, but never gone back to the prior high. And right now, the assumption is, we're going to have to drop $500 from the high to get down to 2,800, and it's going to take a long time, et cetera, et cetera. And this derails people emotionally and a lot of them get out of their positions. And we made a point of that in the last weekend report. We showed, I think it was 2010-11 phase in the gold bull market then, where we were in the acceleration phase. And we circled all the times where you had these scary downside breaks and or congestion zones. And we posed a question at each of the breaks. We said, you got out, but did you get back in? Because usually, boom, if you weren't really precise, if you got out, you didn't get back in, unless it made a new high again, in which case you missed a chunk. You get the point. I think that's where we are. Silver's the wild child. When gold had a mild little pullback during that stock market break in the first week of April, silver had a huge break. It went from $35 to $27.5, much of that occurring in 2.5 trading days. And so if you look at a silver price chart, you wiped out the prior major low in December, which had halted. It had dropped from 35 down to just above 30. It went back up to 35 by March of this year, and then puked through that low like it was the end of the world. And in a heartbeat, It went from 27.50 up to like 30 and a half, 31, 32, 33, and right now we're trading in the 32s. I suspect this sell-off doesn't have much more time in days and or price, and that we can see when we look at momentum, whether we're looking at real short-term silver gold momentum like day-to-day type momentum action, or looking at some bigger pictures, it looks like it's a setup for another surge. In other words, we're just having another pullback. And I don't think silver is going to have another puke. You don't generally have two of them. In other words, if you had one that washed everything out and immediately slingshotted back up into normalcy, you don't do it again. You've had your cleansing. So any people expecting a duplicate cleansing, I think they're wasting their time. Anyway, that's where I think we are. I think we'll come up out of here pretty shortly. And there are some structures overhead on momentum and even on price that say you get back up 34, 35 on silver again, watch out. You could really blow at that point, upside.
So it sounds like silver and gold's pullback may be actually pretty much ending here. So those waiting for lower prices may want to think again.
Yeah. Don't assume you've got to go back to a prior high. That assumption is not proved valid. And there's another assumption that's been kicked into the gutter, okay? I'm tired of hearing it. If the stock market goes down, gold and silver go down. Okay, well, if you look at what's happened over the last couple months, it's been totally opposite to that. Now, there was that one time where silver did puke with the stock market, but then it dusted itself off and said, you know what? I shouldn't have done this. So zoom, you're back up in the 32, 33 zone after being at 27.50. So it was a mistake on the part of those who sold. But gold didn't really flinch that much. And if you go back and look when the S&P made its highs, which would be like in January. In fact, we put out our first sell signal in the first week of January. And 2 weeks later, the market made a new high. S&P did marginally. And that was the top. Go back and look at what happened from gold through March, April, etc. Stock market from January through March, April, total opposites. And now what's gold and silver doing over the last week or two? They're pulling back. What's the stock market doing? Rallying. So in other words, forget that notion going forward that we must move with the stock market. No.
It does seem like there has been a disconnect between gold and the stock market. They're really trading almost reverse to one another lately.
Yep. Yeah, that's the reality that generally prevails over time anyway. Not all the time, but to link the correlation between gold and an incident of a stock market sell-off back in October of 2008, for example, or the COVID sell-off in March of 2020, those are isolated, rare events. They're not norms. And so people make the mistake of remembering only those particular minor instances and treat it as a norm. And they should have learned over the last several months it's not the case. Gold will benefit from a stock market top. We've argued that all along. It hasn't waited for the top to go up. Obviously, it's been going up solidly for a year plus out of that prior range. And but when the stock market breaks, that changes the data points and also will change central bank policy in the Western world. And I think we'll start to see that with the Fed pretty soon. They got numbers today that allows them to twiddle their thumbs some more. Yesterday, they got numbers that weren't too great, GDP. But the unemployment number today was okay, so they can twiddle their thumbs. And I think they enjoy that because they definitely want to, shove it into Trump's lap. So they can say, well, we came to the rescue like a month or two from now when they start cutting rates. They could claim, well, he did it. We're trying to rescue it. But anyway, that aside, they will liquefy events. When the stock market breaks and the data points go, they'll go berserk again. And what does that do? That just helps degrade the value of the money you have by increasing its quantity. And that's what ultimately drives gold over the long term.
Now, when it comes to the stock market, I know in your latest monthly report here, you were saying how you do anticipate the Fed to cut soon based on negative GDP numbers coming out, and that this would be the Fed cutting would be a signal for you to really just run from the stock market. Your perspective on that?
If you're not already out, which we would be, in January we said get out for the S&P, and in early March the NASDAQ 100 said get out, and they both puked. And we predicted a bounce point, and they went right down to our bounce point, just above 4,800 on the S&P and at 16,500 on the NASDAQ 100, two levels that we had predicted prior to that puke that they would bounce from. And they have bounced. It's now been a month of bounce. Most of that bounce, by the way, occurred about 2 days after the low. If you're recalling, it was April 9th when Trump said, okay, we'll have a 90-day pause. The market exploded then, stock market. And we are now above that high, that rally high. But most of the action since then has been below that high until just recently we nudged out above it. And we've predicted that this rally high would reach certain levels as well. So we tried to predict where it would bounce from, done. And then where's it going to go up to? And today, for the first time, the S&P has gotten up to our number area that we suggest is likely zone of resistance. So we'll see. Watch the next few days and see what happens. I know they think the world is now pivoting on one single thing, and that's the China-U.S. trade stuff. And we argue that no, there's a far bigger problem here. That's merely a provoking item that helped reveal internal weakness, the weakness being the effects of the biggest bubble in stock market history, U.S. stock market history. And it's broken, and I think that ultimately you'll find excuses all the way down as to why it's going down, but the real reason is that it deserved to turn down. It was overdone, it was excessive, it created built-in errors, and those errors are being exposed.
I'm looking just like at the S&P chart right now, and it's rallied halfway back from what it's lost, but it still has 500 points or so to really make new highs. So you're thinking that really the highs are in for this cycle?
I think the highs are in. I realize everybody is focused on this China-U.S. thing, where there's talk now that maybe we'll talk. Okay, fine. And therefore, everything's fine. That was just a mistake. Stock market made a mistake. It was a great buying opportunity. Long-term momentum argues no. That break did major long-term damage, and this rally is to be distrusted, regardless of what the headlines would be that caused that factor to occur. In fact, it started down and did a lot of the breakage before the tariff situation really began. So realize that as well. We distrust the rally. I have no personal position in the stock market, short, for example, even though I'm negative. And the reason being that I think being short the stock market will make lesser gains percent-wise than will being long the monetary metals. I'd rather be long the other side of that situation, because I think the percent gains will be far greater than any decline in the stock market. But the stock market is a factor because it's a factor for the central banks.
Now, what kind of time frame, if we look back at precious metals again, are you looking for metals to break out? Because it seems like gold has really just been, for the last, maybe 12 or 18 months, going pretty vertical. It seems like, we're seeing, way above the 200-day moving average and so on. So on your momentum analysis, is there anything concerning about this, the trend over the last 12 to 18 months that gold has just been going so high so fast?
Well, actually, during most of that 12-month period, we started March of last year, so it's been a full year of upside. But really, it wasn't vertical. It was a lot of, like I said, laborious 3 steps up, 1 step back, go to sleep for 3, 4, 5 months. That process. It's only in the last few months that it's really gone what you would call vertical. In fact, you can even see it on price charts now. Momentum did it first, and then price, you could draw a line across the last year or so of upside, and is like a rising line across the highs. And we popped through that a month ago, and we're still above that level, that acceleration level on price. So I think the acceleration in gold has just begun. But when you flip over to silver, they've been caught in a range with a high at 33 back in October of last year, and then a drop. And then they went to, that was May of last year, and dropped. Then in October of last year, they went up to 35 and then dropped again, but it was a higher high. And then this March, they went up to 35 again and dropped and cleaned everything out. And now we're trading in the 32, 33 zone. When we we do a momentum study of that price action, which you could draw a line. You go back to May of last year. It was a year ago, 13 months ago, and draw a horizontal line across the highs that we saw back in May of last year. You're diddle-dawdling on either side of that line. So silver's really not breaking down, but it is stalled with a horizontal line going through the ink over the last year, where it goes above it and below it, above and below it. But momentum during that time, long-term momentum, has had a corrective tubular decline. Price is horizontal, basically. Momentum, it's been a parallel channel that goes back a year. And whenever momentum develops something that clear, I define it with my hands here, but it's like a channel of action on momentum, but it's very old now. It's 1 year old of this process of correcting from overbought levels. Price has only gone sideways, net on balance, while momentum has had its full correction. You break out of that channel again on momentum, and you'll do it up around the 34, 35 level, using the front month silver, which is now July future. You go back up to those highs again in price, momentum will be breaking out of this massive channel. In other words, momentum will be saying, pounding the table, I'm starting again. So though it's been wild but boring for the last year on price, momentum has cooled off to the point where it's created a structure that if you break out of it, you're going to gush on the upside. And so what we're arguing is we think they've had a year of time to go ahead and kill it, but they couldn't. Instead, you've oscillated either side of 33 with two peaks at 35. So we think that the momentum picture says, no, it's too old. You're not going down. You've been going down for a year. You're ready to turn and go the other way. So I think the real shocker here will be silver, not so much gold. Yes, gold has gone into price acceleration, while silver's built this pattern on momentum that says, I haven't even begun.
And if you look at the gold-silver ratio, and I believe we talked about this last time, how it broke above the 100 to 1, and you look at the silver-to-gold ratio, right? Silver being 1% of the value of gold. We almost never see this. So this is just another sign that silver could likely outperform in the future.
If you go back 50 years and look at the silver divided into the price of gold expressed as a percent, 1% is super low. So in other words, either it's going to hell and going to zero, okay, which isn't going to happen, or you're looking at a bargain. Because anytime silver gets down to 1% of the price of gold, look out the next 6 months or so and you'll see drama, okay? In fact, this happened. It got down to 0.8% the price of gold in that COVID sell-off. And in the next 6 months, silver went off the page percent-wise. While gold had a nice, 40-50% move, silver doubled in that 6 months. There is, when you plot the spread relationship, not just the spread itself as a chart, we also run momentum of the spread. And what we're saying is that spread now has gotten bound below the 1% level, and it's just marginally below it right now as we speak. You get back above about 1.1%. That sounds trivial, but when you divide this over into gold and you see it get up, have a weekly close at 1.1% or higher, it's a boarding out of this hole, and it's saying, I'm coming out of here again. And there's another level up at 1.3% of the price of gold, that if you go through that, the lid will come off. You'll gush to 2% in a heartbeat. Well, you say, 1% to 2, who cares? Well, that's a doubling of the value of silver versus gold. It's like buying something at 1 and it goes to 2, okay? So we're keenly watching the silver-gold relationship, because when that breaks out, it's never a situation that you have that gold is going down more than the silver and silver's holding, and therefore silver's appreciating versus gold by not going down as much. It's always a situation where silver's going up much more than gold. So it's always bullish when silver-gold situation shifts into positive.
Some people might argue that, well, the situation is different now, right? Central banks aren't buying silver. Central banks are buying gold. There's talk of, gold revaluation in the U.S., for example. So it seems like all eyes are on gold, and the big countries out there are looking at gold, not silver. So the big players are looking at gold, not silver. But you don't think anything fundamentally has shifted to actually change this dynamic?
I'm not looking at that factor. It's an interesting factor. Gold's been going up for over a decade. And now in the last year, suddenly we have this China situation where everybody has turned their focus like China's buying, China's buying, China's buying. And they try to report on it every week. How much did they buy? And in the other, we understand that just recently there was 1 million ounces sold, which isn't that much, in the bigger scheme of things, from Chinese, probably citizens, not the central bank necessarily. And everybody thinks that's all you get to watch. No, it's not. Gold moves on far broader trends in monetary degradation globally, not just U.S. money degradation, but global. I saw a report the other day that global money supply has gone up 200% over the last 15 years. 200%. Okay, meaning the quantity of money has gone up, therefore the purchasing power, the real buying power of those money units has declined. And for the dollar, going back to the 1950s, every single decade, look at M2 and see it went from here to here, do the percent, and you'll see that it almost doubles every decade. And even more so recently because of what happened with COVID. Also, since the 2009 bear low, they did QEs. Don't be shocked if they go back and do QEs again. And by the way, the other thing I would be looking at in terms of what's the Fed going to do is not just the data points, the economic data points, because they're going to go sour big with the stock market. They follow the market. They don't lead the market down. Is the T-bond market. Something's wrong over there. Treasury bonds are normally another alternative place to put your money if the stock market is in trouble. And yet, since the stock market dropped 20% from January to April, and now has bounced, but the bonds haven't risen. They've tried repeatedly to rise in price, drop in yield. I'm talking 30-year bond futures, for example, not the short end of the market that the Fed controls, but the long end of the U.S. government debt market. It's a dog. Now, we even thought technically there was justification for T-bonds to participate with gold as an alternative to the fractured stock market. And we saw a nice surge. Back early this month, T-bonds shot up to 122 on the T-bond futures from lows down in the mid, 1-teens, 115, 114, et cetera. So there was a big surge in price and a drop in yields. But it crashed. T-bonds in 2.5 days went from 122 in price to 111. For T-bonds, that's a crash. That kind of percent drop, especially in 2.5 trading days. And since then, they bounced back up about halfway to that 122 high. And I think the best we've seen is about 117 or so. Right now, we're trading the 115s. I think even today we traded under 115. So the T-bonds are lame. They're not functioning as they normally do as an alternative place for money managers to shift some money to avoid risk in the stock market. What's going on there? That is of great concern to the central bank and to the government itself. So don't just look at the data points. If that T-bond market doesn't start to behave in a healthy manner, and especially if the stock market starts to go down again and you don't see bonds go up, whoa, what's going on there? Well, we know what's going on. the big fundamental is we have a government debt crisis. The question is, when is it going to occur? And right now, T-bonds in the high 114s. You don't want to ever see the nearby future. It would be the June T-bonds right now, down to 111.5 again. We argue you close a month down there, they're going to flush them. Well, that's what will panic the Fed more than will the stock market. So watch the T-bonds and the dollar as well, which is a crippled bear market as far as we're concerned.
And can you give us an update also on the bank stocks? Because I know you track those very closely, and that is something our viewers are very interested in, is the stability of the banking system.
Well, the banks are sort of secondary to the borrowers. One of the big borrowers is the commercial real estate market. And there's some ETFs that cover that, RWR and VNQ. And if you look at them going back 10 years or so, they didn't participate in that recent stock market surge that took out the 2022 price highs. For S&P, that was 4,800. We went up to 6,200. But VNQ and RWR, they didn't go anywhere near back to the highs. So yeah, they were trying to rally during that time, along with the stock market, but they were anemic as heck. And they started to roll over again like the market. We had an instance about 3 weeks ago where I think the largest shopping center in the U.S. had a $300 million debt default. Headline came and went. But that's the kind of stuff that's built into this commercial real estate market, as I understand. I don't look at its fundamentals, but I hear this from many analysts that there's a lot of debt there that's coming due soon, and a lot of them are in trouble. And therefore, if that starts to become a trouble zone, it will impact banks. And so watch both those sectors. They're more anemic than the stock market. They've had less of a bounce than the stock market. They're going to go with the stock market. So if the stock market rolls over, watch the banks. Right now, the KBE, for example, which is a bank ETF, I think it's trading just above 150, like 151, or is it 51? I'm sorry. But it made a recent low at 45. And if you go back down to 47 again, not even back to that low, watch out. You don't even want to approach that low we saw early last month, which was 45 area. You don't want to go to 47. So about, 4 points below where you are right now, I think it's 51. You go back down to 47, watch out. But again, that's going to be a function probably of some other arena having debt problems that, of course, ricochet into the banks. And that'll be a headline factor at that point again, Right now, banks aren't a headline factor. Instead, we're looking at NVIDIA and Apple and stuff like that. Got to watch these other markets, those other sectors.
And if our viewers are interested in learning more and continuing to track this with you, they can go to olivermsa.com, which you bring your momentum analysis instead of just price analysis, which I find very fascinating. Can you tell us a bit about this?
Well, we look at all the four major asset categories: stock market, debt markets, not just U.S. stock market, others as well. And there are a couple that are in sync with us, by the way, in a negative way. Commodities broadly, foreign exchange, and right now it's suddenly become an active mover. For a couple of years now, the dollar index, and then meaning the euro and the yen, were in a narrow range. The dollar index was like in a 7% range for a couple of years, which is nothing. It wasn't causing impact in the other markets. Now suddenly it is, because it's entered a bear market now. And so suddenly it's become a player again. So we watch Forex and the emphasis on gold and silver.
Fantastic. Well, Michael, we really appreciate your time today. Any last thoughts before I let you go?
No, watch the stock market rally. We're in a zone now where it wouldn't surprise us to see this thing run out of gas. Now, I know we're probably going to get some positive headlines here shortly, China-U.S. type stuff. But again, we argue that technically the bigger structures are broken. These headlines that we see and think are all that matters aren't all that matters. So tend to ignore the news. Pay attention to the broader technicals, and we cover that.
Fantastic. Michael, once again, thank you so much for your time today, and God bless, and have a great weekend.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for April 29th through May 6th, 2025, while supplies last. First this week, we featured 10-ounce silver Royal Mint coins at just $2.99 over spot per ounce. The 10-ounce Britannia, 10-ounce Royal Arms, 10-ounce Little John, and 10-ounce Merlin are all 4.9s fine, and we have a very limited quantity. Again, they're just $2.99 over spot per ounce while supplies last. Next, backdated 1-ounce gold Canadian maples are only $69.99 over spot. And finally, backdated 1/10-ounce Platinum UK Britannia are just $29 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.